Welcome back to the channel. We're diving into what's shaping market trends and the overall sentiment driving them.
Yeah. The US stock market right now, just buzzing with optimism, seeing this surge in investor confidence.
Yeah.
Especially after the election.
Definitely feels like everyone's betting on a brighter future.
You're seeing record highs.
And that record $140 billion flooding into U.S. equity funds since the election.
Oh, yeah.
I mean, some analysts are even predicting all-time highs for the rest of the year.
It's understandable with the US economy's performance. That 2.8% GDP growth last quarter,
Yeah, impressive.
fueled by a surge in consumer spending,
That 3.5 jump in consumer spending, that shows people are feeling confident.
willing to open their wallets.
And that confidence is reflected in how the tech sector is doing,
Mm-hmm.
especially companies at the forefront of AI.
It's remarkable.
It really is.
The S&P projected to gain 27% this year, largely thanks to those AI-related companies. Salesforce, for instance, saw a 14.2% year-over-year increase in earnings per share. They've even raised their revenue guidance.
Wow.
Demand is just that high.
And then you've got Marvell Technology,
Oh, yeah.
major player in that AI chip market.
Uh-huh.
Stock soared 23%. Incredible.
But it is important to remember not all companies are riding that AI wave equally,
Right.
Intel, for example.
Yeah.
While they're projecting strong earnings, they're falling short of their goals for those AI chips.
Even within a booming sector, there are variations. And it seems like some companies are adapting faster than others. OpenAI, they're considering ads on ChatGPT. Their operational costs have ballooned to over $5 billion. It's pretty clear just how expensive it is to keep up with AI.
Absolutely. It raises questions about the future of AI for users.
Mhm.
How will these companies balance innovation with profitability?
Right. Let's shift gears now to the retail sector. We're
Yeah.
seeing some incredible strength, particularly in athletic apparel and beauty.
Lululemon, they raised their fiscal year outlook after a strong third quarter. And Ulta Beauty,
Yeah.
they've exceeded earnings expectations, boosted their sales forecast.
That's great. But it's not all rosy in retail.
Oh.
Foot Locker lowered their annual forecast.
Oh,
Softer than expected holiday demand,
yeah.
especially for Nike products. Seems like brand loyalty and consumer preferences are playing a big role.
Yeah, I think you're right.
Go on.
Speaking of shifts, there's been a lot of talk about sector rotation, where investors move their focus.
Right, right.
Earlier this year, we saw a move from growth stocks to value stocks. But that's reversed. Large cap growth stocks, particularly in tech, they're regaining momentum.
Yeah, and there's a real split in what analysts are saying. Bank of America suggests diversifying into undervalued sectors, like financials, materials, real estate, and utilities. But Goldman Sachs advises diversifying away from large-cap tech and looking at mid-cap indexes, non-tech growth, and even international markets, like Japan.
Two different schools of thought. It's important to understand the why behind those recommendations. Are they based on valuations, concerns about overexposure, or maybe expectations of broader economic shifts?
Definitely. And while we're talking about shifts, the energy sector is undergoing some strategic changes. Shell is exceeding profit expectations under their new CEO. He's prioritizing those core oil and gas operations and scaling back on less profitable, low-carbon ventures.
Makes sense. This strategy has made Shell's shares attractive, even with that volatility in the oil market. It reflects a broader trend, companies adapting to how energy is evolving and what investors want.
Speaking of making companies attractive to investors, how about those dividend increases we've been seeing? Disney increased their annual dividend by a whopping 33%
Wow.
after a blockbuster year. And EasyJet more than doubled theirs after record-breaking summer profits.
These dividend increases, strong indicators of financial health, commitment to shareholders. They signal confidence in future earnings.
Absolutely. Now, there have been some interesting insider trading activities. Several United Healthcare executives, including the CEO, sold $101.5 million in shares just before news of a Department of Justice antitrust investigation became public. We've also seen significant share sales by executives at Apollo Global Management and Rocket Lab USA.
It's always worth noting these significant insider transactions. Their interpretation can vary, but they can also be interpreted as simple portfolio diversification.
Right. Speaking of things to keep an eye on, there are some big economic data releases coming up. The November jobs report is predicted to show an increase of 200,000 jobs.
However, economists are also forecasting a slight uptick in the unemployment rate to 4.2%. It'll be interesting to see how those numbers play out.
Absolutely. And we have upcoming data releases like the Consumer Price Index and the Producer Price Index for November. as well as retail sales data.
Yeah, these indicators give us insights into inflation trends, consumer behavior, and the overall health of the economy, which in turn impacts investment decisions and market performance.
Everything is connected. And speaking of global connections, we can't forget about international markets. Political instability in South Korea and France is impacting investor sentiment. BlackRock's 2025 Global Outlook report highlights transformative forces like AI, the shift to net zero emissions, and geopolitical fragmentation, reshaping those long-term economic trajectories.
It's a reminder that we're operating in a global market. Events in one part of the world can have ripple effects across the entire system.
Definitely. And speaking of global forces, the Federal Reserve has been actively cutting interest rates to support economic growth. All eyes are on their next meeting for clues about future interest rate decisions.
You know, the Fed's actions and statements are closely scrutinized. They provide insights into the health of the economy and their approach to inflation.
Speaking of inflation, that recent 5.1% annualized increase in the M2 money supply, that's certainly something to watch. It follows a period of contraction and has contributed to the current economic expansion.
Right.
But if it grows too quickly, it can fuel inflation.
It's a delicate balancing act. It's absolutely
At the Fed,
trying to stimulate growth but not let inflation get out of control. And that balancing act is evident in the recent discussions on fiscal policy. There's talk of extending those $4 trillion in expiring tax cuts to further stimulate economic growth.
while these tax cuts could potentially boost the economy, they also raise concerns about the budget deficit. Finding the right balance between economic stimulus and fiscal responsibility is always a challenge.
Definitely. And while we're talking about economic forces, the U.S. dollar has appreciated lately.
And that can have ripple effects
Hmm.
across different sectors.
Yeah.
A stronger dollar can impact companies differently. Importers, their costs go down,
Yeah.
but exporters, they face challenges. Their goods become more expensive,
Right.
and it affects emerging markets, those with dollar-denominated debt.
Mm.
It makes it more expensive for them to service that debt.
It does. And let's not forget those disruptions to global supply chains, especially in the tech and auto sectors. Yeah, these disruptions are impacting businesses worldwide. A stark reminder of how interconnected our global economy is and how those disruptions in one part of the world can have those far-reaching consequences.
It really is.
And underscores the importance of diversification and risk management for investors.
Fascinating how events that seem so unrelated can just ripple across markets
Mm.
worldwide, like a giant web.
Absolutely. Like we've seen political instability in one country can cause, a currency to dip
Right.
and then impact businesses on the other side of the world.
Yeah, and those unexpected events,
Yeah.
like the recent natural disasters, they can send those shockwaves through all sorts of sectors.
This year's been rough. For those,
Yeah,
insured losses have already topped $135 billion, fifth year in a row, exceeding $100 billion.
it's a lot.
It is. And it's a reminder, those financial risks tied to climate change.
Yeah, investors are definitely factoring that in more and more.
They are. And then, of course, you have those simmering geopolitical tensions
Always.
that can erupt at any moment.
Like that situation in Syria. The rebel advances, they've really strengthened Turkey's position. But it impacts other countries too, like Russia, Iran.
These shifts in power can have a big impact, especially when you're talking about key players in regions that are strategically important.
For sure. And even those seemingly minor political events, they can still send ripples. Remember when the South Korean president briefly declared martial law,
Yeah.
quickly reversed, but it caught investors' attention?
Markets can be sensitive to that.
They can.
Political instability, especially in those major economies.
Right. And then there's France. The government collapse has created a lot of uncertainty.
Never good for investors.
Not at all.
Yep.
It'll be interesting to see how things play out.
How Macron handles it, yeah. And what it means for the whole Eurozone. It shows you how interconnected everything is. What happens in one place impacts another.
For sure. And
Yeah.
speaking of interconnectedness, that border dispute between Guyana and Venezuela,
Mm-hmm.
just a reminder that those geopolitical risks, they can pop up anywhere.
They can.
Hmm.
And impact specific sectors.
Absolutely.
Like energy in this case.
Exactly. Let's shift focus for a minute. Day traders, what's on their radar?
Well, U.S. stock futures holding steady. Everyone's waiting for that November jobs report.
Big news. Economists are predicting a strong rebound, around 200,000 new jobs. But they also expect that unemployment rate to tick up a little, to 4.2%.
It'll be interesting to see how those numbers play out, how the market reacts if there are any surprises.
Absolutely. Any day trading strategies being discussed?
One strategy, focusing on companies that are exceeding earnings expectations.
Makes sense.
Yeah, those positive surprises create momentum, short-term price movement.
Like Lululemon. Stock is up 9% in pre-market trading. Yeah. After smashing those earnings estimates.
Exactly. Those kinds of surprises, they create opportunities for day traders who are quick to react,
To capitalize on those swings.
Yeah. And then, of course, keeping an eye on those key economic data releases like today's jobs report,
That's key.
they can create volatility, so day traders need to be ready.
For sure. Timing and agility.
Absolutely. Now, for investors who have a longer-term view, sector analysis. Potential long-short ideas, those are important.
Which sectors look particularly attractive?
The consumer discretionary sector has been pretty resilient, not surprising considering those strong earnings reports and the optimistic forecasts.
And the tech sector. Still a powerhouse.
It is, though I imagine some investors are being a little cautious. The materials and industrial sectors, they've been facing some headwinds. It's important to analyze those trends. Consider the market sentiment, which has been pretty high. Of course, some analysts are talking about a possible correction.
Balancing act, weighing that momentum against those potential risks.
It is, and you can't overlook those global influences.
No.
What happens internationally impacts U.S. stocks.
Right. And those analysts, their opinions can really sway things. Their ratings, price targets, all of it.
They can. In the tech sector, for instance, we've seen some mixed opinions. Morgan Stanley downgraded Applied Materials. Concerns about the DRAM market.
Interesting.
Seems those high prices for DRAM-dependent products, new PCs, smartphones, they've dampened demand.
Not good for a company like Applied Materials.
Not at all. Meanwhile, Marvell Technology, they're getting a lot of positive attention. They issued a strong revenue forecast.
Great.
Yeah, their custom AI silicon programs seem to be a hit.
Interesting.
It shows the potential, that specific niche within tech.
For sure.
And Tesla, still aiming for that ambitious vehicle delivery growth.
Right.
But some analysts are skeptical, can they hit those targets,
Yeah.
especially with the competition from those Chinese EV manufacturers.
Right. And what about potential policy changes? Like if the incoming administration eliminates that EV tax credit?
Could definitely disrupt things
Yeah.
for Tesla and for the whole EV market.
Definitely something to watch.
Eh.
What about consumer goods? Any notable analyst calls?
Kroger Co. Their stock dipped. After a decline in sales, they blamed lower fuel prices and the sale of their specialty pharmacy business. But they're still optimistic about their overall sales outlook. They've updated their forecasts.
Short-term fluctuations don't always tell the whole story.
They don't.
You have to consider those long-term trends.
Absolutely. In the financial sector, there have been some upgrades. UBS upgraded both PJT Partners and Peloton Interactive.
Those can be a big boost for those companies.
They can. Speaking of exciting developments, the M&A world, mergers and acquisitions, it's buzzing.
Yeah.
A lot of talk about a surge in U.S. bank mergers. The expectation is the new administration will be more relaxed about bank consolidation.
So we might see a wave of mergers.
Could be, especially among those smaller banks, trying to stay competitive.
Makes sense.
And this optimistic M&A outlook, it's not just banking. It's spreading across industries. Those high stock prices, a favorable regulatory landscape.
We're likely to see more of those stock-for-stock deals then.
I think so, yeah, especially in sectors like energy, media.
Companies want to expand, diversify,
Yeah.
gain access to new tech talent.
We're already seeing some M&A stories like Macquarie. They made a bid to take over Renewy, a waste management company, offering a 57% premium.
Wow, that's bold. Shows confidence in that sector.
It does. And that long-awaited merger, Korean Air and Asiana Airlines, finally got approval.
Big deal.
It is, reshaping the aviation industry.
In all this M&A activity, it's good news for the legal profession, right?
Oh, yeah. They're expecting a busy year.
Makes sense. All those deals require legal expertise.
They do. And while all this is exciting, it's important to remember regulations, they're always changing.
Right.
The Department of Justice, the Federal Trade Commission, they issued new guidelines. They're going to be tougher on antitrust.
Could complicate some of those deals then.
It could. The M&A landscape is constantly changing, so staying informed is crucial.
For sure. Now, I'm curious about those calendar anomalies, those seasonal patterns, the day-of-the-week effects.
Oh, yeah.
How might those play out?
Well, there's the January effect, of course.
Right.
Stock prices, especially small cap companies, tend to rise in January.
It's tied to that whole tax loss selling thing, right? At the end of the year.
Exactly. Investors sell those underperforming stocks, take advantage of the tax losses. Then in January, when that selling pressure subsides, it creates buying opportunities.
So it's this cycle, driven by taxes.
It is. And then for those day of the week effects, there's the Monday effect.
Ah, yes.
Stock returns tend to be lower on Mondays.
Monday blues, even for the market.
Some say it's because companies release bad news on Friday after the market closes.
Impacts those Monday opening prices.
It does. And then, of course, there's the Friday effect. Higher returns on Fridays?
Weekend optimism.
Maybe. But remember, these are just patterns based on history. They shouldn't be the only thing you base your investment decisions on.
They're just one piece of the puzzle, along with, economic indicators, company fundamentals, market trends.
Absolutely. Now, speaking of unexpected events, this year has been full of them.
It has.
Yeah.
Natural disasters, geopolitical stuff, you name it.
Those record insurance losses from those disasters. 5th year in a row exceeding $100 billion. And the concerns about climate change, those are rising.
They are. It's tragic, the human and financial cost. And it's impacting investor decisions.
For sure. And those geopolitical events, like
Yeah.
the situation in Syria, those rebel advances have really shaken things up.
They have.
Creates uncertainty. And when you're talking about key players in strategically important regions.
Impacts investor sentiment.
Absolutely. And remember that brief declaration of martial law in South Korea?
It was quick, but it still raised concerns.
It did. It just shows you these global markets, they're so interconnected. Instability in one country can have those ripple effects.
And then the collapse of the French government. More uncertainty in Europe.
It's a lot to keep track of.
It is. So much going on. Investors have to stay informed, be prepared for those unexpected things.
Absolutely. Now, after analyzing all of this, what are your thoughts on today's opening?
Good question.
Well, based on everything, those earnings reports, market trends, economic indicators, I think we're likely to see a positive opening.
That's good news. What are the main drivers?
Several things. First, those strong earnings reports from key sectors like tech and retail.
Yeah, those positive surprises are always a boost.
They are. They drive that buying activity.
Mm.
It's a clear sign that companies are doing well, making profits.
Reassuring for investors.
And specific sectors like AI and energy, they're showing strong performance.
Those sectors are really at the forefront,
They are capitalizing on those megatrends.
driving prices higher.
And if we look at the market trends, the futures, they're indicating stability, even some upward movement.
So the market's poised for more growth.
It seems that way. And then those macroeconomic indicators. Anticipated improvements in the job market, moderate inflation, creates a good backdrop for equities.
Yeah, reinforces that positive sentiment.
And all that investor activity, record inflows from those foreign institutions, analysts are bullish.
Like everything's coming together.
It is. But we do have to acknowledge those negative developments.
Right. Foot Locker's guidance cut, geopolitical instability.
But overall, those positive earnings, the market momentum, the economic signals, they seem to be outweighing those concerns.
So all signs point to a positive opening.
It's shaping up to be an exciting day. Investors need to stay tuned for those market-moving events, data releases.
Absolutely. And speaking of exciting developments, there's a whole world of emerging stories out there. Things that investors should have on their radar.
The market's always in flux, and those unexpected events can have the biggest impact.
Like trying to predict the weather.
Yeah, you can analyze all the data, but there's always that chance of a storm.
So let's explore some of those emerging stories, things that are capturing attention.
One growing concern, financial contagion, where one crisis triggers reactions in other markets.
Like a domino effect.
It is. We saw it with those bank failures earlier this year. Silicon Valley Bank, Credit Suisse.
Created a ripple effect.
Of fear and uncertainty, shook confidence, showed just how interconnected the global financial system is.
And now regulators are warning that there could be more. Lurking.
Potentially leading to more instability, underscores the need for vigilance, strong risk management in the financial sector.
For sure. And what about those rising global debt levels? That's been on economists' radar.
With interest rates rising, it's getting more expensive for governments, companies, to service their debt.
Could lead to financial challenges.
Like a ticking time bomb. The IMF, they've highlighted this. The uncertainty, potential volatility, it could threaten global financial stability.
Impact those growth projections.
Exactly. It's a reminder we're in this complex, interconnected global economy. What happens in one place impacts others.
And when you add in those unexpected events, conflicts, natural disasters, it gets even tougher to
Hmm.
navigate all the uncertainty.
Like solving a Rubik's Cube on a roller coaster.
That's a good one.
Adaptability is key, staying informed.
Now, emerging markets, they often feel those effects the most. A lot of eyes on China right now.
Their efforts to stabilize their economy are being watched closely by other Asian countries.
Those domestic policy changes can have spillover effects on the whole region,
Research has shown that those spillover effects, from emerging markets to developed economies, they've been growing for the past 25 years.
showing just how interconnected everything is.
It is. What happens in those emerging markets can ripple throughout the world, impact investor sentiment, market performance.
It's crucial to monitor those developments. Be aware of that potential for contagion once that panic button gets hit.
It can trigger a cascade of negative reactions.
And that's why those systemic risks are so concerning. A shock in one part of the system spreads to others.
It highlights the need for risk management, effective regulation to prevent those dominoes from falling.
Absolutely. And we can't overlook the impact of foreign institutional investors on U.S. markets. Their decisions carry weight, influence the market.
There's been a huge surge in inflows from those investors into U.S. equity funds, especially after the election.
Like they're betting on the new administration, their policies.
Optimistic about those tax cuts, regulatory reforms. They expect it to create a good environment for businesses, drive those prices higher.
And is reflected in those record highs in the S&P, the Russell 2000.
A demonstration of how those foreign investments can impact the market, a vote of confidence in the U.S. economy.
And it's interesting, those inflows are happening even with all the instability in other parts of the world, like France, South Korea.
It shows the relative strength of the U.S. market, attractive to those investors seeking a safe haven. If we look at specific sectors, financials and industrials are attracting a lot of inflows.
Investors are bullish on those areas.
They are. But we've also seen some outflows from sectors like healthcare and tech.
Investors are always adjusting, aren't they?
They are reallocating based on their perception of risk and reward.
And those shifts impact individual stocks.
They do, as capital moves in and out of those sectors, looking for the best opportunities, zooming out, looking at the overall sentiment toward the U.S. stock market.
There's a lot of optimism.
There is. We've heard about that euphoric reaction from investors after the election, and the evidence supports it, those record inflows.
Like a wave of confidence.
Analysts are predicting more rallies, new all-time highs. They're talking about those index fund inflows, corporate buybacks, the increase in retail trading.
Like a self-fulfilling prophecy. The more people believe it'll go up, the more they invest.
It's important to remember, markets are cyclical. What goes up must come down. There are some voices of caution out there saying the market might be getting ahead of itself.
A correction could be coming.
They're looking at indicators like the Investors' Intelligence Bull-Bear Ratio. It's been hitting new highs, a potential warning sign.
But even those urging caution, they're still optimistic about the long term.
They are. They see any pullbacks as buying opportunities.
They believe in the U.S. economy, the power of those companies, especially the ones driving that AI revolution.
It's a fascinating dynamic. You have this optimism fueled by real developments, but then that undercurrent of caution, reminding us that markets can be unpredictable.
Investors have to balance those things, make informed decisions based on their own risk tolerance, their goals.
Absolutely. Speaking of informed decisions, let's look at some key developments in the U.S. economy.
Those economic indicators, data releases, what insights do they give us?
Well, the U.S. economy, it showed some real strength in the third quarter. That 2.8% GDP growth rate exceeded expectations, alleviated those recession fears.
That's good, a sign of resilience.
A big part of that growth was consumer spending, which, as we said earlier, is crucial.
When consumers are confident, willing to spend, it has that ripple effect.
It does. And another positive development, that narrowing of the U.S. trade deficit in October. It suggests that American businesses are becoming more competitive globally.
Could impact those GDP calculations for the fourth quarter.
It could. And the Atlanta Fed's GDP Now model, they're predicting 3.2% growth for the fourth quarter.
An acceleration in economic activity.
That's good news for investors. Suggests corporate earnings will keep growing. Supports that bullish sentiment.
While those indicators are encouraging, we have to balance them with those potential risks.
Always some storm clouds.
We have to be aware of them.
One area that's being discussed a lot, the U.S. money supply. It's been increasing. In October, it was about $21.3 trillion.
5.1% annualized increase.
It has contributed to the expansion, more liquidity. But there's a potential downside. If it grows too quickly, it can cause inflation.
When you have more money chasing the same amount of goods, prices go up. Erodes purchasing power.
The Fed is watching this closely. They're being cautious with those interest rates.
Walking a tightrope. Trying to support growth but not let inflation get out of control.
And we're already seeing some signs that inflation might be picking up. The Consumer Price Index, it rose by 0.2% in October. The annual inflation rate is now 2.6%.
Not a huge surge, but enough to keep the Fed on alert.
It could influence those future decisions about interest rates.
Right, if inflation keeps going up,
Yeah.
the Fed might have to raise those rates.
To cool things down, which could impact the market.
Makes borrowing more expensive. Could slow down growth.
That's a complex system.
It is. All those factors interconnected. You have to stay informed. Understand the bigger picture.
To make good decisions.
Yeah, it's a tough balance. Security versus cost.
Yeah.
Businesses need to find that sweet spot.
Right. And across the pond, the European Union, moving forward with that Green Deal.
Yeah.
Aggressive targets for reducing emissions, transitioning to a sustainable economy.
Big implications for industries. Energy, transportation, manufacturing.
Companies need to adapt, invest in cleaner tech.
To stay competitive.
It's a global shift.
Towards a greener future.
Companies that embrace it will be the ones that succeed.
Long term.
Yeah. And alongside those planned changes, there are always those unexpected political events.
Right.
Like the prime minister resigning in France.
Creates uncertainty.
It does, about
Yeah.
their direction politically, economically.
Erodes confidence. Makes it tough for businesses to plan. Political risks are definitely something to consider.
They are. And those protests in South Korea, leading to that brief declaration of martial law.
Things can change quickly.
They can. And it impacts the markets,
Yeah.
underscores the importance of diversification, understanding the political landscape.
Absolutely. Now, back in the U.S., there's been a lot of focus on U.S. Treasury yields.
Yeah, they're closely watched.
What might they signal about the future?
Well, the trend lately has been towards a flattening yield curve.
Which has some economists worried.
It has. Historically, it's been seen as a warning sign.
Of a slowdown.
It suggests investors are anticipating rate cuts by the Fed in response to a potential weakening.
So it's something to monitor, but not a foolproof predictor.
Right.
The economy is complex.
It is. Lots of factors at play. It's just one piece of the puzzle.
Right. I'm really curious about those policy announcements, geopolitical events that are shaping things globally. It feels like it's nonstop.
It is a fast-moving world. Staying informed is crucial. One of the big stories, the Fed's monetary policy, those interest rate decisions.
They've been all over the place. Inflation, recession worries, mixed signals. Investors are on edge.
Well, the latest is they're considering cutting rates next year.
Which has boosted the market.
It has. Lower rates, they stimulate growth.
Makes it cheaper to borrow, invest.
Exactly. And it makes stocks more attractive compared to bonds.
So good news for the market, at least in the short term.
In the political arena, President-elect Trump has been making those key appointments, shaping his cabinet.
Gives us some insight into his priorities, what direction he'll take.
Like his pick for IRS Commissioner, former Rep. Billy Long.
Known for his conservative views on taxes.
It'll be interesting to see what he does.
And Paul Atkins, the new SEC chairman. Expected to be more deregulatory.
Could be good for businesses, but might raise some concerns about investor protection.
Finding that balance again.
Exactly.
What about NASA? Anything exciting happening on the space frontier?
Well, President-elect Trump nominated Jared Isaacman as the new administrator.
Wow.
The billionaire who led that all-civilian space mission.
A bold choice. Shows commitment to space exploration.
And he's chosen former Senator Kelly Loeffler to head the Small Business Administration.
Interesting. She's known for her focus on entrepreneurship, economic growth.
Yeah, we'll see what she does to support small businesses.
These appointments, they tell us something. About the new administration. Focus on innovation, growth, strengthening America's position globally.
For sure. Now, over in the UK, some interesting policy changes in transportation.
Always interested in what other countries are doing.
They've reduced those advisory fuel rates for company cars.
Good for businesses.
Yeah.
Helps lower costs.
And they've made those smart tachographs mandatory for heavy goods vehicles.
Improves safety, efficiency.
And they're expecting insurance premiums to go down due to changes in those personal injury rates.
Makes sense. Modernizing the sector. Promoting safety. Reducing costs.
And to encourage electric vehicles, they're requiring contactless payment at all new public charging points.
Smart. Makes it easier for people to charge.
And there have been political developments, too. Prime Minister Starmer, he unveiled his plan for change. 6 key milestones he wants to hit by 2029.
That's ambitious.
It is improving healthcare, boosting growth, safety, housing, energy, education.
Big challenges.
They are. But they're crucial for the UK's future. It's a comprehensive plan, shows their commitment to tackling those issues, improving people's lives.
It's a reminder that these decisions, they have real consequences. For people, the economy.
They do. Now, those U.S. Treasury yields, they've been a topic of discussion.
We talked about how they're seen as indicators of future rates, inflation, can give us clues about the economy.
That flattening yield curve, some see it as a sign of a potential slowdown, but it's not a guarantee.
Right, the economy is complex. You have to look at everything.
We've covered a lot today. Market trends, sentiment, economic data, geopolitics, policies.
It really has been a comprehensive look at what's shaping things globally.
The key is to stay informed. Do your research. Be adaptable.
The market is constantly changing, but understanding those key trends, those factors, that can help you make better decisions.
Diversification, risk management, a long-term perspective, those are crucial.
They are for navigating these times, achieving your goals.
Absolutely.
Please like and subscribe if you enjoy this content.